Nobody wants that. All right. But you don't get something for nothing. You subject yourself to higher risk, you may get more return. Right? You don't get something for nothing. And lastly, I say here, some people want to protect and grow their capital and avoid chaotic drawdowns. And yeah, that's the bucket that I fall into. If I am trailing the S&P 500 by maybe 5-10% every year, and I have significantly better drawdowns, the S&P 500 is down 40% and I'm down 10%, yeah, I'm way better off with that. Way better off with that, because I know I'll always be able to sell my money for 90 cents on the dollar if I really need it. All right. You'll hear about this idea of beating the benchmark constantly, and I find it absurd, specifically for that idea that, you don't get something for nothing. And if you want to focus on your bench press, you don't get to ignore your shoulders and triceps. You still have a max drawdown, which we're going to talk about as a performance metric. You still have risk adjusted return. And oh yeah, accessibility to your capital, right? If you beat the S&P 500, but you had an 80% drawdown this year, that sucks. That completely sucks as a strategy. All right. What I have here is an animation showing you effectively two different portfolios. One is unhedged. Somebody is willing to assume more risk to try to generate more return. And on the right, somebody who is hedged. Somebody who's willing to maybe spend some of their upside on downside protection so that they don't experience as deep of a drawdown and can potentially even generate more long run returns if they allocate that drawdown capital effectively. So what you can see here in this particular simulation is on the left, chasing those high returns actually produced such a deep drawdown that underperformed a hedged portfolio. That is entirely a reality over these 10 years here. You experience a 30% drawdown. Well, if you have a hedged portfolio and you monetize that capital during the drawdown effectively, you can effectively generate a higher compound annual growth rate relative to a strategy that is unhedged and overexposed to a particular facet of risk, maybe undiversifiable market risk. And here you're actually seeing the hedge portfolio that is to give up some upside for downside protection outperform the portfolio that didn't give up the upside. And that is just one of the profound realizations when you start to understand that there is no silver bullet strategy. Okay? It's all about positioning and survival. What state of the world can you find yourself in and sleep soundly at night? When it comes to assessing strategies and portfolios, you have to remember that everything is backward looking. Nothing is going to tell you how it performs in the future. I'm not talking about some sort of structural inefficiency or an alpha, if you will. Alpha means different things in different contexts. You could be talking about something that's producing return orthogonal to the market. You could be talking about a statistical inefficiency that you're continuing to capture. Maybe it gets crowded out. Maybe you can't allocate too much capital to it, whatever. The list goes on. You have to realize that these performance metrics in the context of a portfolio, that is a portfolio that you're engineering with maybe exposure to US equities or other undiversifiable risks, are a compression of information backward looking. We're subject to the same idea as what? The idea we talked about at the start of this video. All of this information, expected return, volatility, standard deviation, is based on the past. It does not indicate what is to come. We don't get to pick which sample path we walk. Moreover, the past does not necessarily govern the population parameters that generate these future paths. We have a lot of problems, a lot of challenges that we face in reality. It's a difficult space to work in. Okay, so when we look at these performance metrics, how should we think about them? Sharpe ratio, Sortino ratio, measures of risk-adjusted return, right? They tell us different things. They effectively tell us for each unit of risk that we take on, how much return do we get? For each unit of downside risk we take on, how much return do we get? Max drawdown. What is the worst loss that we would have had to experience in an unrealized capacity along our equity curve? CAGR, compound annual growth rate. If it was a smooth ride, how much would we be compounding at? All of these give us information about the paths that we've walked. They don't tell us about the paths that we're going to walk. They tell us, given all of the regimes we've experienced in the past, this is how that performance, this is how that portfolio would have performed. So now understanding that, taking a look at where we're at and where we're going, forward looking, stepping up to the plate, how do we want to position our portfolio? There are systematic strategies you can use. There are different sleeves you can include in a portfolio, and it's going to depend entirely on your risk preferences and what it is you're trying to solve for. Optionality, capital during a drawdown, the list goes on. So this is how we think about back tests, okay? We are not trying to predict anything. We are trying to position for our survival. So for example, here in this particular back test, I have two stocks and I have a 50-50 portfolio of two stocks and a market making algorithm. So you can see here in this back test, what did it tell me? It told me what I already knew without a back test, that a sports market making algorithm has nothing to do with US equity risk. I don't need a back test to tell me that information. Instead, the back test is going to give me insights into how my portfolio would have responded to different events, whether it's a bull cycle, a bear cycle, a sideways bleed, a slow bleed, a fast bleed, it doesn't matter. The back test is simply just telling you what your portfolio would have done. And then what you're going to do is position your portfolio such that whatever is to come, you can experience it, you can manage it, and you can continue to accumulate wealth. All right. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, Quant Guild has two crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.